Here we go. Good morning at 6 o'clock a.m. Pacific Standard Time. It's 5/6/2011. The gift about today is that it's Friday. Okay? And that means that tomorrow's going to be Saturday, and MMTs are going to have time to relax and have coffee and go back and take a look at all of our analysis on our website dating back 2 weeks ago about the correction coming, about the silver, about all the commodities. Oil was a great short, and these things were so crowded that they had to come down. And they have. Today, we have a jobs report. It came out better than anticipated, and people really like the numbers. And what we have is what we call a pre-market on the New York Stock Exchange, and it's called the futures, pre-market futures. Futures move stocks up to the long side, and futures can move stocks down to the downside. Based, if they're selling futures in pre-market, then your stocks gap down in price action. If they're going to artificially, and remember, the stock market opens in 29 minutes, so all of the prices that you see here are not really buy side through, buy and sell through, but it's a beautiful list because it's got the bull right back into its exuberant area. What happens is when we start corrections, we come down 1 day, 3 day, and 5 day ranges. So if we're within a 3 day and we're on the third day, you can bounce the third day before you roll over. The trade management will be when they put in their peaks and their highs, MCP at 2.10. We've got a long expansionary artificial price gap ratio 1.00 and higher all the way up to 2.1400. So the thing about it is, within bear and bull trades, there's going to be what has been sold off, the heaviest retracements, the selling with the public. Those are going to bounce in the short term, but once their bounce is over, they still remain in the overbought area, and they're going to roll over forward looking. Forward looking is over the next 6 weeks. That's forward looking. That's a very short term forward looking. So basically, we got the super hyper volatility in the gap. We remain overbought in all key indexes. So on an intraday short level, there are squeezes that take them higher. But just remember in pre-market that these prices are not buy and side sell opening bell market prices. They're artificial. Why? Because there are instruments that take them up in value from their previous day's close. Doesn't mean that there's a bunch of buyers in there right now buying that. The trade management will remain the same. Cleveland Cliffs really got sold off. This is going to be a good trader here. There is value in some of the selling down in some of these individual names now. And because there is value in some of them in the shorter term for reversal value. But just remember that the reversal could be intraday, or it could be 2 days, 3 days, or 5 days. Just like the reversal down, you have the same counter trend reversal to the upside. Based on bull and bear. So we're going to be selling up on the high side. Cleveland Cliffs is a new addition. Brian Plain knows a lot about it. You can get together with him on how to trade CLF. He'll be happy. You can get together with him on how to trade Caterpillar. You can get with him on how to trade Rio. You can get with him together on how to trade Salesforce. And Fleur System had earnings. That's why that gap up. The ag stocks that were overbloated in prices, well, that's not quite the same as some of the commodities because that was the growth story over there. And so we'll be watching those. But some of the overbought retail that continue to get overbought, you keep watching these progressive overbought levels, MMTs, so that forward looking in the next 6 weeks, you can get the downside profits of those. Bottom line. Gap open down list on the NYSE. WPO, is that earnings related? ARE, but the gap down, and there's that overbought Chinese stock. YOKU down $1.60. Okay, ADR. But look at, you have a diminishing gap down list. And you have an expansionary gap open list within the trend cycle, all contributed to jobs report. Now that they're doing it, there's good names in here. Watch for the short side on that CMG. There's a possible $2 trade right up. You have to have a limit order out to sell into the strength, because if you don't, when they reverse it, you're just going to give up your profits. EOG, we've always said we liked it earlier in the week in a lot of videos, getting sold down. It's a volatility gap back up. We're going to see where that reversal comes in, and or where the short sellers start coming out of some of these short-term oversold. Everything is short-term. Everything does get oversold, but you're seeing the counter volatility gap to the reversal gap down over the last few days. All contributed to Jobs Friday, New York Stock Exchange.